what's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain is you go back a year or so, kind of this time last year, we all remember headline, supply chain's broken down, the shelves are bare. So all true. That was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, or tripled the orders. They said, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff. Retail sales drop off a cliff. The warehouses go from being empty to being full to the rafters. And now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness, the Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve, and they're focused on the unemployment rate, which is not a good measure of what's going on in the labor force. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of that. Some of the buy the dips people are still around, so count on them to, buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the NASDAQ dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. That's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are 2 huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did. And he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. They told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay. It's still not 2. Now what Powell, which is their target. So what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, Forecasting the Fed's the easiest thing I do because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling you what they're going to do is the easy part because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. But the second fallacy is even bigger: is tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay. Yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets where you ended up losing everything. But for a couple of days or weeks even, it's, hey, the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and, a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash, you couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked, but it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later, but that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen. But there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference, there are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, we may have a very bad recession, possibly worse than 2008. But 2008 is a model, and that may be what we're heading for, bearing in mind that these are two separate vectors. If one of our supply chains or one of another country's supply chains that we rely on collapsed, it could cause an unprecedented economic super collapse on a global scale. And that's how we could end up with this $85 trillion economic super collapse I'm predicting. $85 trillion being the value of the global economy. Because remember, our current supply chain is interconnected on a global scale. And if there is a single point of failure, the whole system is going to come collapsing down. Farming, banking, healthcare, oil and gas, tech, and so on. This isn't the first time I've warned Americans about this before. On May 11th, 2020, I told my followers, the economy will not return to normal for years. There are serious constraints on supply. I issued another warning about my research on November 24th, 2021. The supply chain difficulties will certainly grow worse. The remedies will take years and sometimes decades to implement. And yet another in 2022. Don't believe the happy talk about a temporary supply chain crisis. I'll say that again. The crisis will last for years with predictable negative effects on economic growth. But now things are even worse than ever before, and I fear this economic super collapse could hit American soil in the next 6 to 12 months. So this may be my last and final warning before it's too late. It's why I'm warning people around me it's only a matter of time before the world economy comes crashing down. Because when you talk about risk of catastrophic collapse, the risk increases with the size of scale. Look, whether you decide to listen to me today about how to prepare, whether or not you decide to get access to the information in this envelope, that's up to you. It's a free country. You can do what you want. You can even pretend you never heard me tell you any of this. But just know, Joe Biden certainly isn't going to come to your rescue. Take a look at this 9-second clip from the president.
When do you think things will get back to normal?
When do I think things will get back to normal? But my hope is by this time next year, we're going to be back to normal.
That clip was taken over 18 months ago. It's up to you what you believe, but I can't bury my head in the sand and ignore all the facts, and the facts couldn't be more clear. So in just a moment, I'm going to explain how you can get access to this information inside the envelope as part of my super collapse preparation package. And I'm going to talk about what to do to protect and even grow your wealth. Look, please understand, it brings me no joy to say this, and I hope the worst of what I'm warning of never comes to pass. But there's only one potential solution to this crisis, and it's going to take years. Recently, I spoke to a very well-informed CEO of a major corporation, and I asked him point blank, I said, your company must be looking ahead at some possible solution. Is there anything you can share? Well, I'm going to tell you the same thing he told me. He said, Jim, you have to understand that it took us 30 years to build these supply chains. We blew it up in 3 years, beginning in 2018, and you can't put it back together. But there is one thing we can do. It's not a quick fix, but it's our best and most sensible option. Our only way out is to build a new supply chain that eliminates the bad actors. We can't continue to allow our enemies like China or Russia or Iran to threaten consumers here on American soil. As the Wall Street Journal wrote, Russia's lengthening war with Ukraine will lead to a near doubling of inflation rates in rich countries. It's why the New York Times wrote, this is what happens when globalization breaks down. And why Barron's wrote, secure U.S. supply chains with allies and move out of China. Unfortunately, this solution could take years or even a decade to fully implement. And that CEO told me it will take at least 10 years to reconstruct the supply chains if we don't want to do it with China and globalization. But whether you realize it or not, that's the bet we're making as a nation. It's happening now. And when the dust settles, we're either going to have rolled out this new supply chain before worst case scenario happens, or we're going to face whatever lies ahead from this $85 trillion economic super collapse. Now maybe you're wondering how bad things could really get. Let me answer that question with another question. Do you remember your life at the beginning of the pandemic? Despite all of our freedoms we all hold so dear, an unelected official with the ear of the president recommended immediate lockdowns. And suddenly we heard demands like shelter in place or stay at home, backed up by the threat of arrest. Large swaths of the economy ground to a halt. Looting took over our towns and cities. Because so many businesses were shut down, people were emboldened to take to the streets. But if most Americans don't have access to enough food, water, or other necessary supplies, do you really believe our streets and our businesses won't see more violence? It's why gun sales keep hitting all-time highs as more and more Americans prepare for whatever lies ahead. And while I hope the worst of what I'm warning in my urgent new book never comes to pass, I don't suggest you rely on hope to protect yourself and your family. I'm certainly not. Here's how I'm ensuring my family's well-being. First, I would suggest stocking up on essentials, just like I've done. I have a fully finished area in the basement of one of my properties, the address of which I keep totally private. It provides me with a warehousing area for months' worth of canned foods and other non-perishable provisions. That's important. Don't stop with a 3-day supply like the CDC recommends. Make sure you have enough water, basic food, and toiletries to last at least 3 months. And keep them in a safe area where they can sit without damage or spoiling. I would also recommend buying several large capacity freezers. I already have 3 and I may continue purchasing more. If you have the means, consider installing alternate energy solutions in case of a worst case scenario. I've already installed the largest non-commercial solar power system in New England on my property. If you can, have alternative sources of power generation on your property. I've also dug 3 wells, planted abundant gardens, and built a significant greenhouse. But whatever you decide, do recognize that none of it will matter if you're not getting accurate information about what to expect in the coming days. Like I said, to be able to make the right decisions during a crisis, you need to lean on someone. So if that's not me, you should find another well-connected person you can trust, ideally someone who's previously held a position of power in our government. But if you want to learn what's inside this envelope and see what I know, right now is your chance. See, I've gone ahead and published this information I'm holding here in this envelope inside my newest book. It has brand new proof of the unfolding situation and inside-level details on how it will play out. Urgent Preparation Report number 1. Buy this asset after securing your family's food and energy. As the economy collapses and the shelves are bare, the government will respond by printing even more money. When it does, the value of the dollar will be destroyed through inflation. But 5,000 years of history proves that one item, gold, outlasts every other currency as a form of money. And I believe that economic collapse occurring right now will send gold skyrocketing over the next 6 months. That's why I'll send you my urgent report called The Perfect Physical Gold Portfolio. Everything you need to know about buying the right kind of physical gold as part of my Super Collapse preparation package. You'll find everything you need to know about investing in gold before the price blasts through the ceiling, including, is gold safe to invest in? How much should I invest in precious metals? What metals should I buy and what should I avoid? What are the best places to buy gold and other precious metals? What are the safest ways to store gold to avoid theft or government confiscation? And much more. Plus, I'll also send you Urgent Preparation Report number 2, my Biden Bucks Protection Plan. I haven't mentioned it yet, but during my research, I came across a troubling executive order that President Biden just signed. See, every time there's an economic crisis, the government responds with massive new programs to try and control the economy and its citizens. In 2008, it was bailouts of big banks and new government agencies to regulate the financial industry. This time, it will be much worse. I've uncovered a plan for U.S. government cryptocurrency I call Biden Bucks that I believe the government will unveil during this economic collapse to control your money and manage the societal fallout. By the time this program is announced, it will be nearly impossible for everyday Americans like you to protect their wealth and keep their privacy, which is why I've created another urgent report to get you prepared ahead of time. Inside this new report, you'll get step-by-step details on what these Biden Bucks are, why they'll be used during this collapse, and how to outsmart this sinister program by creating, 1, an off-the-grid fortune, secure $1.1 million in wealth inside a soda can safe. 2, saving your freedoms, have liquidity and spendable wealth without using Biden Bucks. And 3, growing your personal wealth. You'll get possible investment upside as events unfold. And 4, ensuring you maintain your wealth regardless of external conditions. Building your own off-the-grid portfolio now will protect you from the government surveillance day coming during the economic super collapse. Biden Bucks testing is underway. The digital dollar could be rolled out soon. Before it's too late, make sure to protect yourself and your retirement savings. You'll find everything you need in this urgent report as part of my Super Collapse preparation package. But that's not all, because you'll also get Urgent Preparation Report number 3. Secure this secret off-the-grid asset. You see, I've learned of another little appreciated asset that's a liquid form of wealth. It can't be tracked or traced. It's completely legal and easy to find if you know where to look. Over time, its value has steadily grown, but very few people know anything about its investment potential. You're about to be one of the few. I believe you must include this secret asset in any off-the-grid portfolio. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my. If you're Argentine and you borrow in dollars and you print pesos, how are you going to pay the dollars back unless you have, huge trade surpluses, which they don't. So they just default. Argentina is a serial defaulter and everyone expects that. If you borrow in dollars and you print dollars, which the United States does, they're like, what's the problem? Just print the dollars and pay the money back. Well, that's true. If you print dollars, there's no reason to default on dollar debt because you actually can print the money and buy the bonds. But it doesn't mean nothing else bad happens. What about inflation or hyperinflation? What about a foreign exchange rate? The exchange rate can collapse. And these modern monetary theorists show very little understanding of the international aspects. They treat the US like a closed economy, which it's not. If it were a closed economy and we didn't have to worry about trade deficits, trade surpluses, capital flows, exchange rates, foreign credit, China owning $1 trillion of US Treasury securities, which they do. If you didn't have to worry about any of that, I think they'd probably still be wrong, but they'd have a better case. But you do. She says, well, we don't really need a bond market, US bond market. We only have a bond market as a favor to investors because it gives them a place to put their money. They say when inflation happens, raise taxes. By the way, they also say you don't need a tax system because if you can just print the money, why do you have to collect taxes? And their answer is, we collect taxes to redistribute income. Okay, well, at least they're honest. I mean, that's kind of a socialist model, but they're honest about it. If you ask the typical member of Congress to define modern monetary theory, they'll look at you funny. They've either never heard of it or they certainly don't know what it means, MMT, Acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior, let's go back to COVID, as we talked about the debt to GDP ratio. So Trump put through a $2 trillion COVID relief package. And that was when, the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check. And then at the end of December, at the very end of the Trump administration, they did another $1 trillion almost. And that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. What the Fed does is nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying, you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone. He did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They just handed them out. And then later that year, they did the $1 trillion infrastructure package. And then, just to top it off, what we get recently was the just under $1 trillion Green New Deal, I call it the Green New Scam. And the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, $1 trillion for the Green New Scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling, and MMT says it doesn't matter. But it does matter, and it shows up the way I described earlier, which is it slows growth. You don't get growth. So best case for the U.S. is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the U.S. will be in fiscal distress. If we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve and, negative swap spreads and Treasury bill auctions with the yield of maturity below what the Fed will give you for a phone call. I mean, all those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last, how are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? We're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41, actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning, but it had started. I mean, in some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. In that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. Third quarter was a lot stronger, 2.6%. But when you dissect that, what you see is that was almost 100% driven by net exports. When was the last time the United States had positive GDP driven by net exports? Probably 1959. I mean, that's typically a drag on growth, and we've been running trade deficits forever. That meant that people were still buying U.S. goods, but the U.S., we were not buying as much from other people. That's indicative of a slowdown. Consumption was weak, private investment was weak, inventories were weak. Those are the real drivers of the economy, and they were all weak. So, okay, net exports, that's not sustainable. So I would look for a recession, a more severe recession, to begin in the fourth quarter. That's one, combined with Fed tightening, interest rate hikes, balance sheet reductions, et cetera. That's one whole vector, and I wouldn't put any weight on a low unemployment rate. It ignores labor force participation rate, which is awful. It's down around 62% versus 70% in the year 2000. But beyond that, unemployment is a lagging indicator. Unemployment goes up after a recession begins. Employers are very reluctant to lay off employees. You got to pay severance. It's expensive to recruit and hire them back and train them. So you pretty much wait until the recession has already started, and you can, all right, I got to lay some people off. So it's not a leading indicator, it's a lagging indicator. So the Fed is behind the curve. There's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So
Hey guys, welcome back to Nifty Invest. In this video, Jim Rickards discusses the relationship between interest rates and the business cycle and the different indicators that suggest an economic downturn may be on the horizon. He notes that interest rates are a lagging indicator and that business owners, entrepreneurs, and medium-sized businesses are often the first to notice when a recession is imminent. He also points out that while the stock market is predicting a soft landing, the bond market is signaling that a recession is coming, and that the inversion of yield curves is a particularly worrisome indicator. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong. but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. If you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So I do, that is my view, but it's shared by a number of other analysts. 1929, everyone's like, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day, it was like 12% one day, 11% the next day, so 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happened. So we're down, NASDAQ's down, bounced back a little bit in recent days, down close to 30%. Down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Jim Rickards explains that interest rates are a lagging indicator, and that people like to question how they could go up if we're in a recession. However, as we get closer to a recession, business people like entrepreneurs, restaurant owners, and taxi drivers are the ones who figure it out first, not the Federal Reserve or Wall Street. The stock market might say that the Federal Reserve is raising rates and inflation is coming down, but it might not be the case.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German bunds, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. Euro-dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. Even the Treasury market. So that's not unusual.
Jim Rickards believes that we are in a triple greatest bubble of all time that includes real estate, stocks, and other asset classes. The bond market is telling a completely different story, and indicating that we might be headed for a recession. This is the best single indicator of a recession, and the last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. The stock market believes that it's a Goldilocks soft landing, but the bond market is saying that it's going to get worse, and it's actually too late for the Fed to do anything about it.
So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. That means they're going to make it worse. They're going to make the recession even worse. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. And we've seen this movie before. This is exactly what happened in 2018. I mean, the Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video.
The Fed will not be able to get interest rates to 5% without causing a recession, not to mention the impact on the deficit and a lot of other things. So the Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing a recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectations are going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between 2 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out. Okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE. I forget if it was 8 or 9, whatever. Lost track of QE. He starts QE 8, let's say. And then that takes you into 2020. And here comes the pandemic and rates go down to 0. And the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen. And it's not clear which, but it's going to be one or the other. They're going to keep tightening, keep tightening, keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You're talking about 40% on credit cards in that world. And people forget, well, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were.
The narrow focus I'd like to start with, since it's the topic of the day, is the dollar. And, I'm going to throw red meat to the wolves here by citing a headline across Bloomberg earlier from Larry Summers talking about how the dollar can continue to move higher because the U.S. has all these great fundamental advantages. This comes, 24 hours after another Bloomberg headline talked about the unstoppable strength in the dollar. So there's the red meat for you, and I'll let you gnaw on that for a little bit.
Well, it may come as a surprise. I think Larry Summers was half right, and I've met him a number of times. He's a brilliant guy. I almost always agree with his analysis and then disagree with his policy. So I always have to stop halfway with Larry Summers. Like, good analysis, Larry, but you're going the wrong way. But yeah, I think he's right that the dollar will get strong. Is probably correct. Also, where I disagree, and this is critical, is the reason why. The dollar is getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. So let's just maybe step back and not be Larry Summers for a minute, but just be everyday investors and asset allocators and analysts and say, and I hate to use the word conundrum because Greenspan used it, but conundrum is a fancy way of saying I don't really understand what's going on. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, highest in U.S. history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the U.S. economic growth is incredibly weak. So we've got high, sky high debt to GDP ratio. By the way, when you look at other countries in the world, you say, okay, who's at that lunch table? 130%. The answer is Lebanon, Greece, Italy. Those are your lunch partners, so to speak. And
this is like the scene from Animal House. Would you like to meet Clayton, Jagdash, and Muhammad?
That's a good comparison. Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. Okay, so they'll probably get back to us, I would bet heavily after the election. But we'll hear from them at some point. But we're in a recession now, and people say, what about the third quarter? And it's interesting because I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP, and they come in at different times with different lags, and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But they say, okay, here's what we think. Here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number, but they don't guess at the stuff they don't have, and it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3. So it's following that pattern. I would expect by the end of September, we still got 3 weeks to go, given what I said about how it fades, it doesn't have to be negative, but it could very well be negative, maybe 3/4 of decline in GDP. But whatever it is, it's going to be weak. So if it's positive, 2/10 or 3/10, I mean, that's okay, but you're still a rounding error away from recession. It doesn't mean the problem's over. So debt to GDP is sky high, economy weak at best, probably out of recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low, went up a little bit in the last report. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce. Yeah. That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs. But if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. So I could go on, but the point is there are all kinds of signs of weakness. So, if we have the deficit, where the baseline deficit is $1 trillion. That's before an extra $2 trillion for Trump's COVID relief, an extra $3 trillion for Biden's COVID relief, if you include the ludicrously named Inflation Reduction Act, right. and the American Rescue Act and the Infrastructure Act. Call it what you want. It's still $3 to $4 trillion. Yeah. 2 for Trump. That's 6 on top of 2 baseline. That's $8 trillion in 2 years. So your deficit's out of control, and your trade deficit's out of control. So what's not to like? And yet you look at all that and say, "What? Are you kidding me? I mean, get me out of the dollar. Go get anything else." Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up and coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. So I'm like a 27 or whatever, a 28 maybe year old lawyer. But I'm talking to Walter Wriston. It's a one-on-one conversation. He was, for those who don't know the name or don't recall, he was probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Wriston was the inventor of the Eurodollar. The negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. So I'm having a conversation with him, and I had just seen this movie, which I highly recommend. Chris Christopherson, Hume Cronin, and Jane Fonda. It's called Rollover. And it's, again, 1980. but All-Star Cast, yeah, I got a murder mystery, a little sex thrown in, but it's basically about the collapse of confidence in the U.S. dollar. And Hume Cronin plays the Walter Wriston part. And basically the idea was, remember, this is during the Arab oil embargoes and the Iranian oil embargo, and price of oil quadrupled in 8 years and all that. So the theme was the Arabs are taking the money out of the banking system and buying gold, and they're stashing the gold away. And this is the collapse of the financial system. And that was sort of the plot. So I said, Mr. Wriston, what about that? Everyone took their money out of the system and bought gold. Wouldn't that collapse the system? And he looked at me like I was a new kid on the block, which I was. And he said, well, what you have to understand is that you can take your money out of the bank and you can buy gold. But the person who sold you the gold got the money and they put it back in the bank. So it doesn't go anywhere. It's a closed circuit. And of course, now I'm like, oh yeah, you're right. Of course he's right. And he said, so the stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates with the price of gold. But he said the money it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. If one of our supply chains or one of another country's supply chains that we rely on collapse, it could cause an unprecedented economic super collapse on a global scale. And that's how we could end up with this $85 trillion economic super collapse I'm predicting. $85 trillion being the value of the global economy. Because remember, our current supply chain is interconnected on a global scale. And if there is a single point of failure, the whole system is going to come collapsing down. Farming, banking, healthcare, oil and gas, tech, and so on. This isn't the first time I've warned Americans about this before. On May 11th, 2020, I told my followers, the economy will not return to normal for years. There are serious constraints on supply. I issued another warning about my research on November 24th, 2021. The supply chain difficulties will certainly grow worse. The remedies will take years and sometimes decades to implement. And yet another in 2022. Don't believe the happy talk about a temporary supply chain crisis. I'll say that again. The crisis will last for years with predictable negative effects on economic growth. But now things are even worse than ever before. And I fear this economic super collapse could hit American soil in the next 6 to 12 months. So this may be my last and final warning before it's too late. It's why I'm warning people around me it's only a matter of time before the world economy comes crashing down. Because when you talk about risk of catastrophic collapse, the risk increases with the size of scale. Look, whether you decide to listen to me today about how to prepare, whether or not you decide to get access to the information in this envelope, that's up to you. It's a free country. You can do what you want. You can even pretend you never heard me tell you any of this. But just know, Joe Biden certainly isn't going to come to your rescue. Take a look at this 9-second clip from the president.
When do you think things will get back to normal?
When do I think things will get back to normal? But my hope is by this time next year, we're going to be back to normal.
That clip was taken over 18 months ago. It's up to you what you believe, but I can't bury my head in the sand and ignore all the facts, and the facts couldn't be more clear. So in just a moment, I'm going to explain how you can get access to this information inside the envelope as part of my super collapse preparation package. And I'm going to talk about what to do to protect and even grow your wealth. Look, please understand, it brings me no joy to say this, and I hope the worst of what I'm warning of never comes to pass. But there's only one potential solution to this crisis, and it's going to take years. Recently, I spoke to a very well-informed CEO of a major corporation, and I asked him point blank, I said, your company must be looking ahead at some possible solution. Is there anything you can share? Well, I'm going to tell you the same thing he told me. He said, Jim, you have to understand that it took us 30 years to build these supply chains. We blew it up in 3 years, beginning in 2018, and you can't put it back together. But there is one thing we can do. It's not a quick fix, but it's our best and most sensible option. Our only way out is to build a new supply chain that eliminates the bad actors. We can't continue to allow our enemies like China or Russia or Iran to threaten consumers here on American soil. As the Wall Street Journal wrote, Russia's lengthening war with Ukraine will lead to a near doubling of inflation rates in rich countries. It's why the New York Times wrote, this is what happens when globalization breaks down. And why Barron's wrote, secure U.S. supply chains with allies and move out of China. Unfortunately, this solution could take years or even a decade to fully implement. And that CEO told me It will take at least 10 years to reconstruct the supply chains if we don't want to do it with China and globalization. But whether you realize it or not, that's the bet we're making as a nation. It's happening now. And when the dust settles, we're either going to have rolled out this new supply chain before a worst case scenario happens, or we're going to face whatever lies ahead from this $85 trillion economic super collapse. Now maybe you're wondering how bad things could really get. Let me answer that question with another question. Do you remember your life at the beginning of the pandemic? Despite all of our freedoms we all hold so dear, an unelected official with the ear of the president recommended immediate lockdowns, and suddenly we heard demands like shelter in place or stay at home, backed up by the threat of arrest. Large swaths of the economy ground to a halt. Looting took over our towns and cities. Because so many businesses were shut down, people were emboldened to take to the streets. But if most Americans don't have access to enough food, water, or other necessary supplies, do you really believe our streets and our businesses won't see more violence? It's why gun sales keep hitting all-time highs as more and more Americans prepare for whatever lies ahead. And while I hope the worst of what I'm warning in my urgent new book never comes to pass, I don't suggest you rely on hope to protect yourself and your family. I'm certainly not. Here's how I'm ensuring my family's well-being. First, I would suggest stocking up on essentials, just like I've done. I have a fully finished area in the basement of one of my properties, the address of which I keep totally private. It provides me with a warehousing area for months' worth of canned foods and other non-perishable provisions. That's important. Don't stop with a 3-day supply like the CDC recommends. Make sure you have enough water, basic food, and toiletries to last at least 3 months. And keep them in a safe area where they can sit without damage or spoiling. I would also recommend buying several large capacity freezers. I already have 3 and I may continue purchasing more. If you have the means, consider installing alternate energy solutions in case of a worst case scenario. I've already installed the largest non-commercial solar power system in New England on my property. If you can, have alternative sources of power generation on your property. I've also dug 3 wells, planted abundant gardens, and built a significant greenhouse. But whatever you decide, do recognize that none of it will matter if you're not getting accurate information about what to expect in the coming days. Like I said, to be able to make the right decisions during a crisis, you need to lean on someone. So if that's not me, you should find another well-connected person you can trust, ideally someone who's previously held a position of power in our government. But if you want to learn what's inside this envelope and see what I know, right now is your chance. See, I've gone ahead and published this information I'm holding here in this envelope inside my newest book. It has brand new proof of the unfolding situation and inside level details on how it will play out. Urgent Preparation Report number 1. Buy this asset after securing your family's food and energy. As the economy collapses and the shelves are bare, the government will respond by printing even more money. When it does, the value of the dollar will be destroyed through inflation. But 5,000 years of history proves that one item, gold, outlasts every other currency as a form of money. And I believe that economic collapse occurring right now will send gold skyrocketing over the next 6 months. That's why I'll send you my urgent report called The Perfect Physical Gold Portfolio. Everything you need to know about buying the right kind of physical gold as part of my Super Collapse preparation package. You'll find everything you need to know about investing in gold before the price blasts through the ceiling, including: is gold safe to invest in? How much should I invest in precious metals? What metals should I buy and what should I avoid? What are the best places to buy gold and other precious metals? What are the safest ways to store gold to avoid theft or government confiscation? And much more. Plus, I'll also send you Urgent Preparation Report number 2, my Biden Bucks Protection Plan. I haven't mentioned it yet, but during my research, I came across a troubling executive order that President Biden just signed. See, every time there's an economic crisis, the government responds with massive new programs to try and control the economy and its citizens. In 2008, it was bailouts of big banks and new government agencies to regulate the financial industry. This time, it will be much worse. I've uncovered a plan for U.S. government cryptocurrency I call Biden Bucks that I believe the government will unveil during this economic collapse to control your money and manage the societal fallout. By the time this program is announced, it will be nearly impossible for everyday Americans like you to protect their wealth and keep their privacy, which is why I've created another urgent report to get you prepared ahead of time. Inside this new report, you'll get step-by-step details on what these Biden Bucks are, why they'll be used during this collapse, and how to outsmart this sinister program by creating, 1, an off-the-grid fortune. Secure $1.1 million in wealth inside a soda can safe. 2, saving your freedoms. have liquidity and spendable wealth without using Biden bucks. And 3, growing your personal wealth. You'll get possible investment upside as events unfold. And 4, ensuring you maintain your wealth regardless of external conditions. Building your own off-the-grid portfolio now will protect you from the government surveillance state coming during the economic super collapse. Biden bucks testing is underway. The digital dollar could be rolled out soon. Before it's too late, make sure to protect yourself and your retirement savings. You'll find everything you need in this urgent report as part of my super collapse preparation package. But that's not all, because you'll also get urgent preparation report number 3. Secure this secret off-the-grid asset. You see, I've learned of another little appreciated asset that's a liquid form of wealth. It can't be tracked or traced. It's completely legal and easy to find if you know where to look. Over time, its value has steadily grown, but very few people know anything about its investment potential. You're about to be one of the few. I believe you must include this secret asset in any off-the-grid portfolio. The supply chain breakdown is causing a lot of the inflation we see. And everyone's like, wait a second, why are you talking about deflation? That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has 2 major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months.
We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and share your thoughts about the video in the comments section below. Thanks and enjoy the video. The renowned economist Jim Rickards continued her speech as follows.
In the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Here's another, $30,000 or whatever, because people would quit, and that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. That's kind of a nasty way of putting it, but that's how cost push inflation tips into a recession and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now, it came back by 77 for a lot of reasons, but right now we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. I don't know what the recession is a cure for. It's coming. The recession is coming. And Jay Powell said this. Jay Powell gave 2 speeches, August 26th, Jackson Hole, and September 21st at the press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And then Jackson Hole, he was like Nancy Pelosi. He tore up a speech and wrote a new one, like literally the day before. It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one because the Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins. The dual mandate is price stability and low unemployment. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from 3.5 at the moment, if it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever. So they're willing to do that. And they also think the recession, if it comes, will be mild. But those two things together will get inflation under control.
The renowned economist Jim Rickards continued her speech as follows. I, in the statement from Powell, indicated he didn't express that. Their focus is on the core PCE, the Personal Consumption Expenditure Price Index, core, meaning excluding food and energy, and everyone's like, why would you exclude food and energy? Once again, I'm not here to argue about it. That's their approach. They aim to achieve a 2% core PCE annually. Powell didn't mention that we're going to increase rates until core PCE is 2%. He didn't say that. What he stated was that we'll raise rates until it has a constraining effect on inflation, and inflation will naturally decrease because rates will be sufficiently high to prompt that, at which point we, the Federal Reserve, will pause. Then you ask, well, when will you lower rates? He was like, the pause could last a year. So you're talking. TW. Let go of this Fed policy change nonsense. You're talking about 2024 before they reduce rates. It's similar to what I recall from Vietnam, the old saying, we had to devastate the village to preserve it. We have to damage the economy to rescue it. This is the most recent in a long series of Federal Reserve missteps since 1913. It seems to be their specialty, but that's what they're doing. And on top of all that, there's an impending global liquidity crisis, a worldwide financial crisis that differs from a recession. It's a financial panic, and recessions are distinct events. They can occur independently. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can coincide. It appears they might be coinciding again. This is evident in inverted yield curves. Major dealers are competing in auctions for treasury bills. The Fed will provide you with treasury bills with a single phone call. All you have to do is contact the Fed and conduct a reverse repo. They'll provide you with some treasury bills. However, banks are bidding in auctions for treasury bills that yield a maturity lower than what the Fed will provide with a phone call. Why would they do that? The explanation is that the Fed bills cannot be rehypothecated. They cannot be used as collateral. However, the auctioned bills can. This indicates there's a collateral shortage. This implies reducing balance sheets, financial distress. And we also observe it not only in the Treasury yield curve, which is inverted from 6 months to 10 years at present, but also in the Eurodollar futures curve, which is even more concerning. It's not unprecedented, but it is rare, and it's not a good sign. Nevertheless, the Fed persists in raising rates despite this extremely unfavorable data. So, I anticipate a significant recession in the US, and the global outlook is fairly grim. Moreover, there's the possibility of a global financial liquidity crisis worse than 2008. If all I've said is accurate, which I believe it is, or I wouldn't be stating it, they could, at the very least, take a break now or even reduce rates. But if we're on the brink of a global liquidity crisis, as indicated by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with a yield at maturity below what the Fed will provide with a phone call. All these developments are taking place. That's hard data, and it's a very, very concerning sign. Less evident in 2008, incidentally, prior to the Lehman Brothers collapse. So, with the economy naturally entering a recession, along with the brewing global liquidity crisis, why on earth is the Fed raising rates at all? That's unsustainable. So I foresee a more severe recession. That's one aspect, combined with Fed tightening, interest rate increases, balance sheet reductions, and so on. That's one whole dimension, and I wouldn't place much weight on a low unemployment rate. It disregards the labor force participation rate, which is abysmal. You know, it's around 62% compared to 70% in the year 2000. However, unemployment is a lagging indicator. Unemployment rises after a recession begins. Employers are very reluctant to lay off employees. You have to pay severance. Recruiting and rehiring them and providing training is costly. Employers typically wait until the recession has already commenced, and they say, oh, well, I have to lay off some people. So it's not a leading indicator, it's a lagging one.
Don't forget to like our video and subscribe for our channel.
Disinflation, definitionally, but maybe even deflation is the opposite, at least for the time being. Inflation is the end game. It has to be, because there's no way out from under the debt. But right now, and people are still worried about inflation. Prices are still going up. I put gas in my car just like everyone else, so I'm well aware of it, eggs, bacon, et cetera. But inflation has been coming down steadily since June of 2022. So about 7 months in a row, 8 months in a row. It peaked then. We all know what gas prices were doing and so forth. But the reason is kind of interesting. And inflation, nominally, prices are going up. Okay, so that's inflation. But it can come from two sources that are opposite. One is from supply side shocks, supply chain disruption. We saw that in 1973 with the Arab oil embargo over the Arab-Israeli war at the time. The price of oil quadrupled, et cetera. That was a supply shock. The thing about supply side inflation is it's self-negating. It burns itself out. So, the old saying, and it's true, the cure for high oil prices is high oil prices. In other words, when things get too expensive because of supply disruption, people can't afford them, businesses close, you get layoffs, you go into recession, and prices come down pretty quickly after that. The other source of inflation is from the demand side, and this is a completely different dynamic. We saw this in the late 70s, where prices are going up, but people have some bargaining power, so unions are on strike, they're getting higher wages. I worked at Citibank in the late 70s, early 80s. They used to give us raises without asking. They just say, here's another $20,000, because they knew that the cost of living was going up, and we would all change jobs if they didn't pay us more. So, but that feeds on itself. So the supply side disruption tends to snuff itself out. The demand side inflation tends to feed on itself. It gets out of control. And then we saw what Paul Volcker did with interest rates in 1981, where he took them to 20%. He caused a recession in terms of tight monetary policy to snuff out the inflation. But otherwise, if you don't do that, that just runs away. Now, the inflation we saw in 2022, late 2021, 2022, it was real. It wasn't transitory the way Jay Powell said. The price of gasoline doubled, more than doubled, and all the other complaints you hear, the filling up your Ford F-150 pickup truck went from $70 to $140, which for a lot of people that meant they couldn't eat or couldn't, go out. It was killing demand in, entertainment, shopping, retail, a lot of other things, which again tends to snuff it out. So that has happened to a great extent. Starting in June 2022, that was the peak, and this inflation has been coming down. Now, it's still too high. The Fed's not done. We're going to see at least one more interest rate hike, maybe, but they're going to leave one more on the table. We'll see what happens in June. I'm not forecasting June, but I would not rule out another interest rate hike in June after the May hike. So, because Jay Powell's thinking, how many times do I have to say this? He's given 9 speeches since August 2022, August 26th at the Jackson Hole, then September FOMC meeting, November FOMC meeting, end of November, a speech at the Brookings Institution, December FOMC, congressional testimony, et cetera. And every time he said the same thing. Inflation is job one. we've got to get unemployment up. Believe it or not, we're going to have a recession and unemployment's going to go up. Sorry about that, but we've got to get inflation under control. And until we do, and what's under control mean? Well, it's 2%. That's their goal. Well, it's come down from 9 to 5. Nice job, but 5's still a far cry from 2, and it gets harder as you go along. And they're searching for what they call the terminal rate. So the terminal rate, no one knows what the number is. I don't know because Jay Powell doesn't know, but the terminal rate by definition it's a rate that's high enough that it brings inflation down on its own without further rate hikes. Because so far they've been raising rates and inflation's been coming down. Okay, that makes sense. And they can keep raising rates and it'll come down more. But is there a level where, we're there, now we can sit tight, the famous pause, and inflation will keep coming down. Now you don't know because it's not a controlled experiment. You can't do it twice. But they're getting close. So whether it's 5.25, 5.5 remains to be seen. But that's the terminal rate. But then Wall Street came up with this narrative. Oh yeah, as soon as they're done hiking rates, they're going to cut them. This is the famous pivot we've been hearing about for over a year at this point. No, as far as they're concerned, forget rate cuts in 2023. Maybe mid-2024, we'll get back to you on that. But there's one wild card in the deck, which is that's the Fed's plan. So I just gave you the Fed's game plan. It's not, you don't need a crystal ball. They tell you what they're going to do. All you have to do is listen, although a lot of people don't. Wall Street makes up their own version of that. But the idea of rate cuts following hitting the terminal rate is, well, rate cuts go down, so dividends look higher, so buy stocks. Wall Street is always buy stocks. That's always the punchline. But they might cut rates late in the year, not because it's their plan, not because they want to, but we could be in a very severe recession. And that at which point, because the Fed's always late, they're always following the market. They never lead the market. If they've already raised it, let's say they may already be at the terminal rate, not know it. And so if they keep raising, which I expect they will, they may throw this economy into a very severe recession, at which point they may have to cut rates, not because it's in the playbook, but because unemployment goes up to 7%. And but that gets back to the first question, Constantine, which is what's next? Disinflation, maybe deflation. The answer is diversification. Everyone goes, oh, we know that, diversification. But they know the term, but they actually don't know what diversification is. And I'll give you an example. I run into people all the time. They go, well, Jim, I'm fully diversified. I have 50 stocks in 10 different sectors: telecommunications, semiconductors, consumer non-durables, metals and mining. And I go, you're not diversified. You may have 50 stocks, but you're in one asset class called stocks or equities. And they're all going to go up together or they're all going to go down together. And the more stressful the condition, the more reason you have to be concerned about it, the higher the correlation. On any given day, some stocks go up and stocks go down. But when you dial the stress meter up, they all tend to move together. So I don't care about your 50 stocks, your 10 sectors, that's not diversified. So what does real diversification look like? Have a sleeve of equities if you want, that's fine. I would say I look hard at oil, natural gas, natural resources, agriculture. Again, kind of equities that have hard assets behind them that will do well in inflationary times or even in recessionary times, because you need all those things no matter what. Then a slice of real estate. I wouldn't be in commercial real estate, but residential real estate, income producing real estate, farms, etc. That's good. I have a big slug of cash. And people go, well, cash doesn't have any yield. Well, lately the yields, you can get 2-3%, on like a CD. But even in a simple savings account, it is quite low. It's kind of less than 1%. But people don't understand the value of cash in a couple of respects. Number one, in a deflationary environment, we're not there yet, but we could hit that if the recession gets bad enough. Cash could be your best performing asset. It doesn't go up in nominal terms, but it goes up in real terms. If you have 2% deflation, your cash is worth 2% more in terms of purchasing power. But the real value of cash is optionality. And this is not well understood. I shared an office with Myron Scholes for 6 years, so I see options under the pillow, so to speak. But if you're the one with cash, when things, first of all, it'll definitely preserve wealth. So if things are falling all around you, your cash will be what it's worth, unless you're in Silicon Valley Bank. It's a separate issue. But although they got bailed out. But so it'll preserve wealth, even if it's not a high performer. It'll do very well in deflation. But the real benefit is when everything else is falling apart, you're the one who can go shopping. So it's kind of an at-the-money call option on every asset class in the world. Everyone's selling everything in a panic. You can bide your time, watch it go down, look for a bottom, and then say, okay, now I'll buy these things down 30% or 40% or 50% from where they were. Some alternatives. I have a number of investments in private equity and venture type situations, and they're risky and they're not liquid. But some of them will do very well. Some of them have done well, so that's nice. And then a slice of gold. And I recommend 10%, because people, they put words in your mouth. They go, Jim Rickards says, sell everything and buy gold. I've never said that. Not a good strategy. But 10%, yeah.